Hi, welcome back. This session I'd like to talk about inflation, a topic that we've been able to avoid for almost 3 decades because at least in the US and Europe, inflation has stayed dormant. To understand why inflation is back in the headlines, let's take a look at 2021. It's been a pretty good year for stocks, right? The S&P 500 is up about 11%, and while the Nasdaq is underperforming the S&P 500, it's still up about 5%. But it's been a bumpy ride, with two competing forces pulling and tugging at markets. On the good side, the economy is doing a lot better than expected, and that's good for earnings and growth, and that's been good for markets. But on the other, there's this concern that as the economy comes out, especially with the monetary and fiscal stimulus on top of it, that inflation could come back with it as well, and that could be a negative. To understand inflation, though, we need to go back to basics. Let's start with the definition of inflation. Inflation is a measure of the change in purchasing power in a given currency over time. Take a look at the definition, because implicit there are two components of inflation that we can never forget. The first is, it's a change in purchasing power, which means you got to talk about what you're purchasing, a basket of goods and services. So inflation is always specified in terms of something you're buying, a weighted average of goods and services. The second is it's always specified in a currency. There is no global inflation rate. There's an inflation rate in US dollars, an inflation rate in Indian rupees, an inflation rate in Brazilian reais, but currencies carry inflation with them. So how do services measure inflation? Well, let's start with the basics. In every part of the world where inflation is measured, most countries try to do it themselves. The service starts off with a basket of goods and services that a representative consumer buys. Already you can see why different services can end up with different baskets. Because clearly that basket is going to vary widely across individuals based on age, based on wealth, based on what part of the country they live in. It could also vary across time. What I buy in my basket today could be very different 6 months from now. But services start off with specifying that basket. So if that basket is misspecified, inflation is going to be misestimated. Second, services try to estimate the prices of the goods and services in that basket. Now, clearly, you can't go to every store in the country and check out prices. So there's sampling done. Sampling of retailers, sampling of what consumers pay. And services in some countries have become very good at the sampling, but it's still sampling. There could be error in how you estimate those prices. In some countries, of course, governments with the intent of making inflation look lower than expected can play games with how they get those prices, getting prices from price-controlled outlets rather than from a free market. And finally, some of those goods and services in the basket are going to have seasonal factors, rising in December, dropping in June. If you're not careful, your inflation is going to bounce around, so services try to smooth out seasonality. So for the same country, 3 different services can end up with different inflation measures based on different judgments they make on these dimensions. But all of these are measures of actual inflation. Markets are driven by expected inflation, and there are 3 ways you can estimate expected inflation. One is you can do surveys of consumers, of producers to see how much more they're paying than they did in the previous period. What do they think inflation will be in the future? The second is to use market-driven numbers. The problem with surveys is there's no real money behind a number, so a survey participant can give you any number they want. But markets has real money behind the number. And if you have markets where you have rates on both a default-free security and an inflation-protected version of it, the difference between those rates can give you expected inflation. And I'm saying, what are you talking about? Let's take the US Treasury market. There's the T-bond rate, which is a nominal rate. So the T-bond rate is 3%. The US Treasury is promising to pay you 3% in nominal terms every year for the next 10 years, if it's a 10-year bond. But in the US Treasury market, there's also a rate called the TIPS rate. It's an inflation-protected rate. And that rate you get no matter what the inflation is. You get the inflation as an add-on on top of that, so it's a real rate. So if the T-bond rate is 3% and the TIPS rate is 1%, the difference of 2% is expected inflation. The third way you can get inflation, which is if you have a base currency where you know the inflation, let's say the US dollar, and I give you exchange rates in another currency, Brazilian real to the dollar, now and in the future, you can use those forward exchange rates to back out the expected inflation. It's a little messy, not too many people use it, but you could use it. Now let's take a look at interest at the treasury market and what it's giving you as signals of expected inflation. Remember, it's the difference in the T-bond rate and the T-bill rate. In this graph, the blue line is the T-bond rate. The orange is the TIPS rate. The difference between the two is expected inflation. In May of 2021, for instance, the T-bond rate was 1.62%. The TIPS rate was 0.8%. That difference of minus 0.8%, the difference of 2.42% is expected inflation. You can already see that's substantially higher than it was a year ago or even 2 years ago. And that's one factor. When people are worried about inflation, you'll see this show up in the expected inflation rate. Now you're saying, how does this number compare to the survey numbers? In this graph, I have the University of Michigan survey, which is done every month of consumers of inflation versus the rate you get from the treasury market. The Michigan survey seems to consistently deliver higher expected inflation numbers than the treasury market. But the two move together, so they're clearly being driven by the same forces. So you've got actual inflation, you've got expected inflation, and here's how you connect the two. If the expected inflation for next year is 2% and actual inflation comes in, that actual inflation can be higher than expected, in which case you have unexpectedly high inflation, close to expected, in which case your inflation came in as expected, or lower than expected, in which case you have unexpectedly low inflation. The difference between expected and actual inflation is called unexpected inflation. You're saying, who cares? We're going to talk about how these two play out in value and they can have very different effects. Now, at the risk of causing some ire, let's talk about what drives inflation. I'll make a confession, I'm not a monetary economist, but to me, inflation at its core is a monetary phenomenon. In fact, pure monetarists believe that everything else is noise. If you print too much money, there will be inflation. That said, there are other factors that clearly drive inflation. If you have excess capacity in your economy, either because you're coming out of a recession or a crisis, you could have monetary stimuli and not see inflation. If there are structural changes happening in the economy, you're going from a manufacturing to a service economy, from a domestic to an export-oriented economy, in that period of transition, inflation can be higher or lower than expected given purely monetary effects. If consumer behavior is changing, the demographics are changing, the behavior is changing, you could show up in inflation. As consumers age, for instance, they spend less, you could see inflation go down. It's perhaps no coincidence that the two parts of the world with the lowest inflation, perhaps even deflation, are Europe and Japan, which have populations that are aging faster than any other part of the world. And finally, this isn't fair, but the larger and more dominant economy is, the more slack that's built into the system for that economy to break the rules and not face the consequences. A US or EU can print more money and not see the inflationary consequences that a Chile or an Indonesia will, simply because the size of the US and the EU economy. So the bottom line is, in the long term, it's pure money driven. But in the short term, and the short term can stretch into many years, there are other forces that drive inflation. Now, one way to think about why this is a time when people's concerns about inflation are rising is to look at another survey number, it's not a survey number reported by the Fed. Now, the Fed actually uses survey data, actual data, multiple, I think as many as 9 different data sources to come up with a probability that inflation will exceed 2.5% and a probability of deflation. They've been tracking this number for a while. This graph, I've listed out what those track numbers look like. So if you look at the end of April of 2021, 61%, there's a 61% probability that inflation will exceed 2.5% and only a 0.11% probability of deflation. You're saying, what's the big deal? Take a look at just a little under a year ago, in May of 2020, there was a 0.11% chance that inflation would exceed 2.5% and a 77% chance of deflation. How quickly things have changed. There is clearly concern that inflation is going to rise, and you see it in multiple dimensions. Now, I told you earlier that inflation is a currency phenomenon. and high inflation, and so if inflation varies across countries, you're going to see it show up in multiple places. Here, for instance, I've looked at inflation, expected inflation between 2021 and 2026 as estimated by the IMF for different countries. The red parts of the world are the countries with the highest expected inflation rate. The dark green are the countries with the lowest expected inflation. The yellow falls somewhere in the middle. The gray is not available. Argentina is not available, but trust me, if Argentina had a number, it would be red. At the bottom, I have a table that lists out the countries with the highest inflation. No surprise, Venezuela is at the top, and countries with the lowest expected inflation. Switzerland is at the top. Now you're saying, where does this play out? When you look at risk-free rates by currency, which is something I do every 6 months, you see that rates vary across currencies, and high inflation currencies like Zambia and Turkey, Zambian kwacha and the Turkish lira, are reflective of the high inflations in Turkey and Zambia. The low inflation currencies are in countries with low inflation rates. So with that background to inflation, let's take a look at the history of inflation in the US using 4 measures for inflation. The one is the Consumer Price Index. This, the US has been calculating and reporting since 2013. And since 1913, 108 years. And since 1948, they've done a seasonally adjusted version of the CPI. So this measures inflation to consumers. The US also reports on a PPI, Producer Price Index, where it looks at inflation to producers, manufacturers. And finally, there's an estimate called the GDP deflator, which the US uses to go from real to nominal GDP, which is a measure of inflation in the goods and services produced in the US, including those for export. First, the 4 measures move together for the most part, and there is no one measure that consistently gives you higher or lower numbers. Some decades, one measure is higher and others, the others, which is a good sign because it indicates that bias is not driving any of these measures systematically over time. But inflation history, you can see if you look across the last 100 years, the 1970s were unusual for the US. A decade where inflation reached double digits in some years, but on average was 7 to 8%. And by the same measure, 2010 to 2019 had the lowest inflation rates in almost a century. That's good that we have the highest inflation decade, 1970s, and the lowest inflation decade in this table, because we can look to see how different asset classes behave during those periods. Now, before we look at the actual returns on stocks and bonds and gold and real estate during these historical periods, let's develop some intuitive feel for what we should expect to see. Let's start with how inflation affects value with fixed income securities. In a fixed income security, i.e. a bond, let's say you're the buyer of a bond and I'm a seller, we set contractually how much I'm going to pay you as a coupon at the time the bond is issued. Of course, when you set the coupon, you bring in the expectation as the buyer of what inflation is going to be. So if you expect inflation to be 3%, it would be irrational of you to set a coupon at 2%. So presumably expected inflation is something you can build into the coupon rate and protect yourself. But unexpected inflation is out of your hands. What am I talking about? If actual inflation comes in higher than expected, you don't get to adjust your coupon. You still get the same coupon. You know what's going to adjust? The price of your bond. The return on a bond is composed of the coupon plus the price change. And when inflation is higher than expected, your prices will drop. The bond price will drop and your returns on bonds will be negatively affected. Higher than expected inflation is bad for bond returns. Lower than expected inflation is good for bond returns. And that's even assuming no default risk. If you bring in default risk and corporate bonds, there's a second dimension. As inflation rises and interest rates go up, companies might be more exposed to default risk because they now have to make higher interest payments. That could get them into trouble. Higher default risk translates into higher default spreads. So with corporate bonds, in addition to all of the effects you get in any typical bond, you get the additional effect of default risk. So fixed income securities are hurt by higher than expected inflation and are helped by lower than expected inflation. What about stocks? It's complicated. Isn't it always with stocks? Because everything can be affected. Let's start with the negatives. When inflation is higher than expected, it shows up as a higher risk-free rate, presumably higher risk premiums. You're saying why higher risk premiums? Because higher inflation seems to go with more uncertainty about inflation. Higher inflation seems to go with higher default spreads, so discount rates will go up. In addition, as we've noted, when inflation increases, there's a greater chance of failure risk. So the negative of higher inflation is higher discount rates and higher failure risk. What are the positives? When inflation increases, companies should be able to raise the prices of their goods and services. Revenue growth will go up, at least in nominal terms. But not all companies are equally powerful at raising prices. Companies that have more pricing power will be more protected against inflation, see higher revenue growth than companies with less pricing power. Margins could be affected as well. You're saying, why? If revenues go up 8% and costs go up 8%, why does it matter? Well, if they both go up by the same percent, it doesn't matter. But inflation can play out in different ways on revenues and on costs. For a company where revenues are not very sensitive to inflation and costs are, as inflation goes up, your margins will decrease. If your revenues are sensitive to inflation, your costs are not, then your margins could actually decrease if your costs go up and your revenues stay constant. Did I say that right? Let me back up. So if your revenues are sensitive to interest rates and your costs aren't, margins will increase as inflation goes up. But if your revenues are stuck and costs are sensitive, the reverse will be true. Your tax rates might even be affected. You're saying, why? Well, the actual tax rate might not change. Some of the tax benefits you get, like the benefits from depreciation, will be affected by when inflation goes up. And here's why. The amount you get as depreciation is set based on what you originally paid for an asset. And as inflation goes up, the depreciation stays the same, but the present value of the tax benefits you get lower, effectively raising your tax rate. So the positives of inflation are your cash flows will be higher. The negatives, your discount rates are higher. The risk of stating the obvious, if the cash flow effect, which is a positive, dominates the discount rate effect, your value can go up as inflation goes up. If the two offset each other, your value would be unaffected. And if the costs exceed the benefits, your value could decrease. So for individual stocks, inflation can help, inflation can leave you unaffected, or inflation can hurt. That's for individual stocks. So if I were to state a general proposition, I would expect the effects of inflation to be disparate. Some companies might benefit, a few might be unaffected, and a fair number are going to be hurt by inflation. In fact, if I were to look across all stocks, my guess is, and this is based on just looking at history, the net costs are going to exceed the net benefits. I am hard-pressed to visualize a scenario where higher than expected inflation is actually good for stocks. Well, that's in theory and intuition. You're saying, what about the actual numbers? Well, let's look at what stocks and bonds have done in conjunction with what inflation has been, going back in time to 1928. So this graph is a little messy, but the black line is the unexpected inflation every year. You're saying, how did you get the unexpected inflation? I used a very simplistic measure. I looked at the actual inflation rate each year and compared it to the average inflation in the previous 10 years. So the actual inflation rate is 3% and the average over the previous 10 years is 2%. That difference of 1% is unexpected inflation. And I did that every year. It's the only way you can get unexpected inflation going back to 1928. The green line is stocks, the red line is corporate bonds, and the blue line is T-bonds. You think, what do I make of this? Tough to read, but maybe this table will help. I've broken down stock and bond returns by decade and looked at inflation in each decade. Let's start with the 1970s. As we saw earlier, the worst decade in terms of inflation. It's a decade where unexpected inflation was 2.8%. In other words, inflation on an average base was 2.8% higher than expected each year for those 10 years. Well, stocks and corporate bonds basically tread water, right? They were both around zero. So they had flat decades. Think about it. You invested for 10 years and in real terms, you made almost nothing. I've reported both nominal and real returns. And T-bills and T-bonds were both negatively affected. If you look across periods, stocks, clearly there's more going on than just inflation because there are periods where inflation is higher than expected, where stocks do well. But with T-bonds and corporate bonds, it's quite clear that inflation is a dominant factor. In periods where inflation is higher than expected, T-bonds and corporate bonds do badly. In periods where inflation is lower than expected, they do well. So if we were to summarize across financial assets across the last 90 years, no financial asset class has done well when inflation has gone up, but bonds have been hurt more than stocks. Now, if you look at real assets, I focused on gold and real estate because those are investment hedges, supposedly good hedges against inflation. And I've looked at the returns on gold starting in 1970. You're saying, why only in 1970? Because before the abandonment of the gold standard, there was very little you could learn by looking at the price of gold, which was pretty much fixed every year. Since 1970, the price of gold has gone up and down. And you can see that the 1970s, you saw spikes in the gold price. The green line is real estate returns. The way I've computed this is by using a data set created by Professor Robert Schiller at Yale, and I'm eternally grateful for that data set, where it looks at home prices going back to the 1800s. I've looked at returns since 1928, and that's a green line. Again, it's tough to read the graph, but maybe this table will help. If you look across the decades and look at the 1970s, clearly it was the decade for gold. The annual return was 37.5%. And on a real basis, gold was up 30% a year. Real estate wasn't bad. It wasn't as good as gold, obviously, but it kept up with inflation, which you couldn't say for many other asset classes. It clearly did much better than stocks did during that period. But with real estate, there are clearly with both gold and real estate, there are other factors to consider. If you look at 2000 to 2009, it was another good decade for gold. And it was a period where inflation was actually fairly low, both on an expected and unexpected basis. What happened between 2000 and 2009? You had the 2008 crisis. Gold serves two roles. It serves as a hedge against inflation, and it serves as a crisis asset. And you see both roles play out, both in what happened in the 1970s, what happened in 2000 and 2009 and 2020. What about cryptos? I know that question was coming. Now, because there are people who think of Bitcoin as millennial gold. You're saying, has it served as a hedge against inflation? Unfortunately, we don't have the data to answer that question yet, because it's been around only since 2008. And in the 12 years it's been around, inflation has been low. The only way we'll find out is if inflation spikes. We're going to find out very quickly whether Bitcoin is going to behave like gold. But there's another dimension as a crisis asset where at least so far Bitcoin has not been impressive. In 2020, which was a crisis year, I looked at Bitcoin and Ether and compared it to stocks and gold. And over the year, here's what I saw. Bitcoin behaved more like risky stock. And you can see that in the correlation number there. It moves more with stock than it does with gold. It went down more than stocks when stocks were going down. It went up more than stocks when stocks were going up. It didn't behave like a collectible. Obviously, this is one pass at history. Maybe it'll do much better in future crises. But so far, the evidence is paltry that Bitcoin is behaving like millennial gold. Bringing it all together, I looked across asset classes to see which ones were the best inflation hedges and which ones were the worst. Let's start with the two best inflation hedges. Gold and real estate historically have been positively correlated with both expected and unexpected inflation. But there's an interesting difference. Real estate actually works better as a hedge against expected inflation, perhaps because you can build it into your rent, your expected rent payments much more easily. But on unexpected inflation, gold is a much better hedge. No financial asset has worked well as a hedge against unexpected inflation. Bonds have done worse than stocks. And stocks, if you look at actual inflation or expected inflation, have kind of tread water. But overall, looking at this graph, if inflation is what you're worried about, no financial asset class is going to provide you a hedge against unexpected inflation. So what now? Let's sum up where we are. Clearly, inflation is back at the moment. Nobody's going to debate that. You see that in the actual numbers, the CPI, the PPI, the GDP deflator, in expectations, the Michigan survey from markets, and in commodity markets. You see lumber rising, commodity prices soaring. The big question, though, is this transitory or permanent? The people who believe it's transitory believe that this reflects the coming back of economies from a total shutdown, and you should expect inflation to jump when that happens. But once we get back to normal, their argument is inflation should settle down. The people who believe it's some part of it at least is permanent argue that the stimuli that have been added to to both the U.S. and the European economy will cause inflation to rise, and we won't know which side has it right until much later this year. If we're still talking about inflation coming in at higher than expected in October, November, and December, the people who believe that there has been a permanent shift in inflation will be winning this argument. If inflation is back to 1 or 1.5% by October, November, December, the transitory school has won out. If inflation is up permanently, the question is to what level? If the return here is to 2.5 or 3%, which is what would have been normal 10, 15 years ago, I think there'll be an adjustment. It might be painful, but it's not going to be something that's going to require massive reallocation of assets. You could even stay with stocks, move your stocks across sectors, perhaps to more price-sensitive companies, to commodity companies, and not be hurt too badly. But if there's a chance, and there is a non-trivial chance in my view, of a breakout in inflation to 5, 6, 7, 8%, that's going to be something that most investors and most companies are not used to. That adjustment is going to be painful. It's going to be painful for investors because they have to come up with new asset allocations to reflect the higher inflation. It'll be painful for companies, especially companies that have borrowed too much at low rates, because the refinancing at the higher rate could increase their default risk. Now, what about central banks? For those who believe the Fed can somehow act as your defender against inflation, let that go. The inflation is something that the Fed cannot control. At least using surface level actions. Now, in my view, given that there's a non-trivial chance of breakout inflation, I think it's time for the Fed to stop its happy talk. What am I talking about? Stop talking about inflation being under control. Stop talking about interest rates staying low. In fact, speak less, act more. If inflation starts to come out, I think of inflation as a genie in the bottle. As long as it stays in the bottle, it's harmless. But once it comes out of the bottle, getting it back in there is not easy. And if as central banks around the world look at this phenomenon, they have to make a decision as to which risk they worry about more. The risk that the economy will stall and the risk of inflation coming back. And they can't let the economy dominate this discussion, because coming back from high inflation can be really painful. Now, and on that depressing or perhaps cautionary note, I'm going to end this session. Thank you very much for listening, and I hope to see you soon.